So hello everyone. So today we are very lucky to have a guest speaker in our class, Mr. Boyan Doytchinov, and he's the Director of Financial Planning of Snyder Capital Management. And Boyan has worked in the financial service industry for more than about 20 years. And he has earned his bachelor degree in economics as well as MBA degree in finance from Stony Brook University. And so he's our alum, and he has been a long-term supporter of the College of Business. So we're very lucky to have you, Boyan. Welcome.
Thank you, Professor Jiang. And you're a little generous to my experience, but let's call it rounding up.
Okay. So maybe I'll start with some background information for our students so they know what's coming. So here in this interview, we want to discuss about the impact of the COVID-19 pandemic crisis on financial planning for individuals as well as for families, right? So just give a little bit of statistics for our students. I want to mute everybody, so make sure they are not interrupting, okay? So just give everybody a little bit of statistics. So the pandemic has started over 2 months now, and stock market has plunged over 35% at some point and have bounced back by about 20 to 25%. And we have seen the highest volatility probably in the recent decade. It's exceeding the volatility we have seen in the 2008 to 2009 financial crisis. 95% Americans have been ordered to stay at home, and 26 million Americans have filed initial jobless claim, which is a record in a 5-week period. Today, we actually got the newest data, which is another 4.4, adding to get the 26 million jobless claim. Okay, and in the middle, we have the Saudi and Russia oil price war that has led to the plunge of the oil prices. And one Monday, I think we have seen the most bizarre thing in history, right? The oil contract expiring in May has plunged to negative $37 a barrel. So everything looks wrong, and and a lot of stimulus bills are passed, and on my account, and according to CNBC, the Fed and the Treasuries and the government has basically printed $6 trillion, right? Rescue bills or lending programs. So what is the implication, right? We know there is a crisis out here. We're in a recession, probably a huge recession here. What's the impact of this crisis on our individuals and our families in terms of financial planning?
So I'm going to try. Oh, here we go. You can hear me now, right?
Yes.
So you're exactly right. We're probably right now already in the recession, which is just starting, and the recession is 2 negative quarters of GDP growth, as broadly defined, as you probably know from your classes. But we've only been in this for about 6 weeks. So, how can we be in a recession already? Well, it's pretty obvious that this is going to be a recession by the time the economists define it that way. It'll be many months from now. But like you said, Professor Jiang, very broad impacts on the economy, very devastating impact on people, on their livelihood, on their employment. People may lose their homes. Right now, fortunately, due to the pandemic, most people are not losing their homes because they are sheriffs and banks and so on are prevented from foreclosing. Landlords are prevented from evicting tenants. So we haven't really seen the full scope of the pain that's going to result from this. And the government has put a lot of funds into the recovery, into attempting to at least shore up the the economic decline, but that's going to be a pretty drastic impact once there's more data out.
Right.
And some people are, seeing, lesser impacts. People in essential work, healthcare workers, obviously, are seeing less impact on their finances, but a huge impact on their mental health and on their physical health, as they are physically exposed to the virus in high doses on a daily basis. So without getting into all of that, which I don't have much expertise on, I just have a sense of what's going on out there. I'll talk a little bit about how it's impacting our clients, how it's impacting.
Right. Maybe starting from most of the clients you're working with, maybe starting with the age group who are near retirement or have retired. Then we can go down to the age group, maybe to the middle-aged individuals and families, and then to the younger generation, and our students are more interested in.
Yeah, of course. So let's start with let's call them the grandparents out there, the people who are probably already, most of them already retired and living off of their portfolios. Those are the people that are seeing the biggest impact on their financial plans up front, because they're already in a particular level of lifestyle. They're already used to a level of expenses that they are sustaining, and they have sustained for years. And all of a sudden this year, in a matter of a month, we had 35% of the stocks disappear. Now, recently, much of that has recovered, but if somebody looked at their account on March 23rd, they could have had a heart attack. Even for clients who had a moderately conservative allocation, which many of our clients do, with maybe, let's say, 45 to 50% in stocks overall, I'd say that's a pretty moderately conservative allocation. It's not crazy conservative, but even those clients were quite nervous about the declines that they were seeing if they looked on March 23rd when we hit the bottom, at least for now. I'm not going to say.
Yeah, did you see people were panic and started to sell their shares?
We had a lot of calls. That was a really tough time. The week before, especially that week, and afterwards, as the market recovered, things got a little bit more quiet. People settled down a little bit. But we had a lot of nervous people who were calmly panicking. I'm not going to say that they were calling and screaming, although I did hear anecdotally from some of the staff who sometimes take the front line. They get the first call. I did hear from them about, I apologize, so-and-so calling and screaming, literally, yelling at the top of their lungs, saying, what have you guys done? I've lost so much money. And then by the time the call is transferred to me or one of the other advisors, the client's gotten some of that steam. They've blown some of that steam off. They've calmed down by then. And by the time we speak to them, it's a little bit more of a rational conversation, and they get it. They understand they're in the markets with a percentage of their investments, and a portion is going to be at risk. They get that, and sometimes they forget it temporarily, and they blow off steam. But for them, once we spoke to them and they realized how they were positioned, most of those clients ended up staying the course. Basically, they ended up not selling, even though that's what they called with the intention to do. They called with the intention to sell. And remember, we're not making the final decision. Our clients have final say. If they want to sell, ultimately they will sell. We had, with many of them, very long conversations, upwards of an hour on the phone. You can imagine it's draining to be doing this over and over again.
Right. So the focus here is to stay with the plan, right? Stay with their initial allocation, try to rebalance, as opposed to engaging panic selling, right?
Correct, for the most part. And I'll say with a few exceptions. There are a few exceptions where there was an imbalance, where the client perhaps initially was a little bit more bullish than they ended up being. In other words, they weren't fully experienced with the ups and downs of the market. And they started out with an allocation that, we always work with the client on the allocation. We come together to that conclusion of what should be the percentage of stocks and bonds. But in a couple of cases, it turned out that the client started out with, let's say, 50% in stocks. And we thought that was appropriate from our perspective. And the client completely felt comfortable with that. And some of them even wanted to be a little bit more aggressive in January. And then it turned out when they saw the dip that they really just couldn't handle that level of volatility. And it turned out that for those clients, we should pull back on the equity risk and we should have a lower long-term strategic allocation. But for the vast majority of them, we held off and we prevented them from panic selling at the bottom and making that change. And we're able to defer that change until better times. And for a couple of them, we made that change later on.
So for
those
investors, so you're saying for investors, even understanding their true risk aversion is a challenge at this point, right? They didn't know that until they couldn't stand the risk, right?
Because for those who remembered 2008, that memory for many of them, although they remember it, the memory fades. And they're more, it's called the recency bias. I'm sure you probably talked about it, where investors are more inclined to remember and put a heavier emphasis on the recent history and assume that that's what the future is going to look like. And they saw a year last year that the market was up 30%. Bonds were up in the teens in some cases. And, what could go wrong? So there were only a few people who weren't well prepared. I would say most of our clients were well prepared, and we were more conservative than usual because of our understanding of risk and the fact that the market was overvalued. So that helped our clients cope with the decline, because when they turned on the news and they saw the stock market was down 30%, and they checked their account and their account's only down in the high teens for the more aggressive clients. For the more conservative clients, I don't even know if we reached the mid-teens. Some clients were down in the 12, 13% range at the depths of the bottom, and they were very comfortable with that. They understood and they held on. And we did make a couple of moves, not perfectly at the bottom, because we're not. We don't have a crystal ball. We don't know exactly when things will turn around. But we did feel back in March that a couple of times we had a good opportunity to rebalance, because remember, our starting point was a little conservative. And as the market dropped, we recognized an opportunity to rebalance and shift from those overweight bonds into the underweight stocks a little bit. And put that money to work. And the timing, at least in hindsight, at least for now, seems to have been good. And those clients are benefiting from that.
Okay, excellent. So do you advise people to make some lifestyle adjustments given some damage has occurred to the portfolio anyway?
Absolutely. We communicated with our clients early on that, given the severity of the situation, we would strongly recommend to most of our clients to reconsider major expenditures. Trips are obvious. I mean, you're not going to be able to go on your trips for the short term, but things like renovations, home renovations, other major planned expenditures, we strongly recommended that they reconsider those. And any sort of discretionary expense that they were planning, think carefully before going ahead with those plans, because we still don't know what's in store for us. This is a new territory, and we're all driving
Yeah,
with
we're not out
with
of the
no
woods
map.
yet, right? So this is not over yet, right? We don't know how long it's going to be. So be prudent.
Absolutely.
Is definitely helpful. And also, this is probably for people who have the portfolio. They rely on the portfolio for to cover the living expenditures. How about for people like my age who have a family? Now, maybe a lot of people are facing potential unemployment risk or have been laid off, right? And the CARES Act allow people to withdraw money from the retirement accounts, penalty free if it's COVID-19 related needs. So what's your advice to family facing the liquidity constraints? Should they tap the retirement accounts or not? And what's your advice?
Yeah, very good question. That's the last resort. Well, almost the last resort. I would say the first place, if somebody's laid off and cannot cover their expenses, I would say the first place is to renegotiate those expenses. So if it's a landlord, if it's the bank, see what kind of relief is available, as part of the CARES Act, as part of additional state regulations, saying that, while we're dealing with the situation, you're not going to be evicted. Your home is not going to be foreclosed upon. And consider, yes, it's going to have an impact on your credit score. So that's something you have to think about. But sometimes it's appropriate to sacrifice the credit score if you're not going to need credit in the short term. Sacrifice that credit score in favor of maintaining a little bit more cash. So the next place I would say is think about tapping the emergency fund. And for every person, that's going to be different. Some people, their credit is extremely important to them, and they are going to be less inclined to renegotiate their debt and have a blemish on their credit score. So they're going to go and draw from their emergency fund. And that's fine. This is exactly the type of situation where these emergency funds are designed for. So once somebody loses the income, emergency, what order you choose is up to you, but emergency fund and negotiation. Next, I would think about tapping the retirement accounts. I think that would, maybe not the last resort, but that would be a distant third option, because even though the government's made it easier to access those retirement accounts, it has other negative impacts. So taking money out of the retirement accounts is going to be taxable. Yes, you can spread the taxes over 3 years. That's part of the CARES Act, but that's still additional taxable income. And if you return to work before the end of the year, and all of a sudden you've taken a large amount of money from the retirement account, all of a sudden you could be in an even higher tax bracket than you would have been otherwise.
Right. And also they will be forced to sell at the lowest price, right? If they that's an
even bigger factor, because taking the money out of the investments means it's not there to recover if we have a recovery from here in the stocks.
Right. So we reminded our students and also their family members, if they're facing any challenge, I think the first resort is actually the government unemployment benefits.
Yes.
And also the pandemic expanded benefits include $600 per week benefits, which lasts 39 weeks instead of the typical 26 weeks. That's going to set a lot of people income, right, for a while, right?
Yeah.
Before they think about emergency fund or maybe their retirement accounts. And also maybe can people just borrow against the retirement accounts instead of withdraw on the retirement
accounts? In 401k, and I believe in some 403b plans, that's an option. In other words, employer-based plans, the loan is an option. And in some cases, that's a better option because the funds remain invested. You're not disturbing the asset allocation, so you're keeping the long-term mix there, and you're borrowing at a relatively low interest rate against your own money. So you have the collateral there. That's why it's a low interest rate. So it's a much better source of cash in the short term than potentially selling that retirement account, triggering the taxable event on the withdrawal, and then having to deal with the 3-year spread of taxes, the 3-year possibly putting the money back. Yes, you do have those options, but you just don't know. So my first and most important piece of advice would be, if you run into trouble, talk to a professional. Don't rely on advice from a family member. They absolutely mean the best and they have your best interest at heart, but they don't have all the information. Family members, unless they happen to be a professional, are likely not going to know the details of all these laws and all the changes and how these things, because they're very complicated, can impact one particular person in one way and their sibling in a completely different way.
Right, right. So for younger generations in their 20s and 30s, suppose a young professional has a job, right? So what should he continue investing in for retirement? What's the ideal allocation during the pandemic, during the crisis, or in the next several years to come? What's your recommendation?
I am a strong proponent of, I'd call it somewhat traditional portfolio management practices. And what we've been doing and what we are recommending, and it's absolutely working. It's working to the advantage of our clients, and it's working to our advantage. Rebalancing. When you have an asset allocation and you have, let's say you're young and your asset allocation is, let's call it 85% stocks. Just an example. I'm not saying that's appropriate for every young person. Just an example. And the stocks are down 20%. And you went from 85, and I can't do the math right now in my head, but let's say you went from 85 to 70% in stocks because of the drop. Well, think about rebalancing. If you still have your job, if you still expect that you will have your job in the foreseeable future, and this money, even if you lost your job, you have an emergency fund set aside. You do have, let's say, longer term money. That long term money that's invested 85%, it was 85% in stocks. I would seek to rebalance that back, maybe not all the way to 85, because you don't want to be that aggressive. You don't want to be
gradually, right?
But bring it back up to 75, maybe even to 80%, to get back closer to your target asset allocation. And if you do that, and then let's say the market has a full recovery, then it's back up. And instead of going to 85, now you're at 90 because it had a full recovery. Then you bring that back down to 85 from 90. If all you remember is to rebalance, when stocks go through the roof, trim them. When stocks are crashing, buy more. If that's all you do, that's a really good way to introduce discipline and force yourself to buy low and sell high on a regular basis. It's very simple rebalancing, and it sounds great. And we had these conversations with our clients, over the years, and they always agreed. And like, of course, that's what we're going to do. But it was much harder to convince them to do that and get their, acceptance in the midst of March and what was happening in March when the market was crashing.
Right.
But that's the discipline. You have to be a little bit more aggressive when things are falling off a cliff.
It's difficult to stay rational when we have emotions, right?
Yeah. Because we ultimately do believe in the economy long term. We do believe we have a strong economy. We do believe that we're going to learn a lot from this, and we're going to come out of this better for the long term.
Right. So for emergency fund, right? So usually when we talk about this in class, we talk about 3 to 6 months of emergency fund. Of course, you first want to have $1,000, right? You can dip into, but beyond that, right? To avoid unemployment, right? The challenges associated with job loss, we typically recommend 3 to 6 months emergency fund of worst of living expenses. So do you think people should raise that or should keep roughly 3 to 6 months, or they are okay to lower it a little bit because we're already in the middle of a recession?
Yeah, so it's highly dependent on the situation again. I hate to give that answer, but I'll give you a couple of examples. So somebody who's in a very stable career, very predictable income profile, and very good likelihood to keep that career. I'll give you an example. A police officer who's been on the job, 5-10 years, established. That is a very strong career, very stable. It may not be the highest income earning career available out there, but at least it's strong. Those people don't need a big emergency fund. For those types of clients, we do have some police officers. We are comfortable recommending to them they have, a smaller emergency fund, closer to the 3 to 6 months. For clients who have highly volatile income, salespeople, where it's based on the commissions that they earn, which is based on the sales that they generate, which is entirely based on the economy and their performance, a year of emergency funds could be a very appropriate, level. And it also depends on what's currently happening in your life. Ideally, if you're still employed, or let's say you're working from home, but you're not sure what's going to happen with your job, now is the time where you want to be shoring up that emergency fund. And what better opportunity? I mean, we can't go anywhere, we can't travel, we can't, there's not much we can spend money on. And resist the temptation to shift the spending to online spending and so on. This is tough advice, because the advice I'm giving you is going to hurt the economy. But I do think
for individuals, it's a prudent thing to do. It may not be optimal aggregate, right?
Exactly. So unless you're very confident in your job, if you are, I would say live your life. I wouldn't engage in additional new spending. But if you have that, think about all the savings you're having from not being able to travel, from not being able to go out to restaurants. Think about redirecting that savings to your other goals. Maybe this will help accelerate your ability to retire. Maybe this will help you jumpstart your savings for a down payment on a future home. Think about good ways to put that money to good use. Not necessarily just saying, okay, well, I'm not going to spend money on restaurants. Maybe I'll buy more stuff on Amazon. Most people won't do that anyway.
Right. So it's the time to change spending habits, just to be prudent and prepared, right?
Exactly.
So lastly, thank you. So lastly, I think our students are interested in knowing the job and career. This is probably one of the most brutal job markets that our graduate seniors will be encountering in the summer. And you were there, right? You graduated around the Great Recession, right? So
I did.
What would be your advice for our students to take this time at home to really prepare themselves for the challenges ahead? Anything that can be positive coming out of this crisis for our students?
Yeah, so I had the pleasure of graduating in 2008 in the midst of the greatest recession since the Great Depression, and it was tough. I remember sending out, and I'm not gonna lie, I didn't send out hundreds of resumes, because I put a lot more thought and I was very much more focused on what I was sending. But I send out many dozens of resumes, probably close to 100 in the span of that year, and it was crushing to not get responses and to not get interviews when you put so much thought and effort into each one. And I had the ability to redirect and quickly adjust my plans. So as I was about to graduate, I was able to apply for the MBA program at Stony Brook, and I was accepted quickly. And fortunately, I was able to start right away. So I didn't have a gap. But even 2 years later, when I was graduating from the MBA program, it was still not a rosy job market. So I would say if you're about to be graduating now, you should think about all of your options. And for many people, it will be perfectly fine and okay to take a job that is not your dream job. You're not going to get your dream job fresh out of school one way or another. I mean, that's a fairy tale. But you may get a job that at least gives you a foothold into an organization, gives you a starting point to build experience. And I do think that, people like me who graduated in very bad times have to work a lot harder. But even in good times, it's not easy for fresh graduates going into the labor market. So be prepared. What's going to be different this time is you have to be prepared to be much more adaptable. I know people who have gotten new jobs almost solely through remote interviews. And as the pandemic accelerated, I know a friend who was supposed to start a job in London this month on April, I think it was supposed to start on April 4th. They shipped him his laptop, and that was his start date. They stayed with the original start date despite the pandemic, and he started, and he's working for his new company in London from Long Island, and eventually he's going to move there, just not right now. And things are moving. Things are changing rapidly, and if you're adaptable, if you can highlight that in your resume, in your interview, you're going to come off as a stronger candidate, because right now employers are going to value adaptability and flexibility tremendously.
Right. And also the skill sets employers are looking for are somewhat different now, right? We heard a lot of people are losing jobs. We also heard every small business is needing people to help them put their business online, right? And to do the social media marketing. So anyone who have those skills, would have a lot of opportunities out there. So you never know. It's not like the demand goes to zero. It's just a different demand, a different scale at a different place, right? We just need to basically acquire those skills that's highly needed in this new markets, right? New normal. Okay,
exactly.
So our students, so you have heard about the interview so far. Any questions you have, feel free to put in the chat box. So I have one question here, Boyan. So the question.
Yes, I see it from Felix, right?
Okay, what was the toughest part of entering the finance world as a financial analyst?
Getting over the reality that I really want to take the time to think about this, but I want to give you one answer, is that I had one vision in my mind, which is I was going to go into the city and work in Manhattan in the concrete jungle, and I'm going to work for a big company with a training program, and I'm going to learn the company inside and out, and I'm going to grow from there. That was my vision for my career when I was
the
in
ideal
college.
Starting point, right?
Yeah. And I started working at a local firm, the company I'm working in now, and I was an intern, and I was just helping, with basics, and I was quickly expanding my level of involvement in the firm and the type of work that I was doing, how I was helping. But I still had that vision of going into the city and working for a big company. So I was interviewing, and the owner knew that I was interviewing into the city, and I went regularly to different companies. And at one point, after about almost a year of interviewing and going back and forth, the owner of the firm said something to me that just opened my eyes finally. And he said, well, I like what you're doing for me. I'd like you to stay. What would it take for you to stay with me? And, maybe the city is not that appealing. And that was the first time that I even entertained in my mind staying and working longer term at that firm.
Mhm.
And we negotiated a reasonable starting salary, and I just wanted to have healthcare coverage and make a reasonable living. And lo and behold, I didn't expect it, but he was perfectly willing to meet me in terms of where I wanted to be, and I got off the ground. So you don't always realize what's available out there. It may be right under your nose. It may be your internship. It's just because it's a smaller firm doesn't mean that you're not going to make a living. It doesn't mean that you're not going to be challenged and you're not going to be growing professionally. It's different. I didn't have, a huge ladder, corporate ladder to climb. I didn't have any of that. I didn't have, promotions and that sort of thing. I didn't have, multiple mentors to work with. But I had to adapt. I had to, I continued to stay in touch with my professors from the MBA program and from friends and acquaintances and people from the different internships I had done. And, keeping in touch with everyone provided me the mentorship that I needed. And taking initiative on my own career development meant that I could shape it myself and I could, decide where it goes. Several years later, I went to a firm in the city and there was a totally different situation there. Even though it wasn't a much bigger firm, they acted much more corporately. And I don't know if that's a word, I apologize, but that firm was much more laser focused in your career path. And you have this title and then you have that title and then you just move on through the titles and this is your role and this is what you're supposed to do and how you're supposed to conduct yourself. And they had very specific, exact expectations. And I didn't realize how much I would hate that. So the vision I originally had about the corporate environment, I got a taste of it, and I ended up coming back to the firm here in Long Island. So I'm back to the same place. Obviously a different role, and I'm much more involved with the portfolio management now, with financial planning with the clients. So it's, the experience in the city was good, but it opened my eyes to how the world could be very different. But thank you. That was a
your
good question.
new role is now important, and you can actually make a difference in individual's life, right?
Exactly.
Right. So your story reminds me of Bill Grove's story, who is the bond king. So
Yeah.
one of the interview by Barry Rittles asking him, why did you choose to trade bonds instead of stocks when you entered the job force? He said, because nobody would hire me to be a stock trader or stock analyst. So that's the only thing I got. And he emerged as one of the greatest investors in bond trading. So being adaptive and take the opportunity you are given and go from there, right? That's honestly the best strategy. A lot of people start that way and become very successful, right? So we have one more question, maybe the last question. I don't want to take too much of your time. So we have a question from Suzanne. She was asking, what do you think is a good alternative skill for students to have going into the business workforce? Something we may not have learned in school.
I think that sales are always important. And
marketing.
Marketing and sales. So, you learn a lot about marketing from a formal academic perspective with, the research and, how to, create a good marketing plan for a new product, etc. And I remember that, I really enjoyed my marketing class, and I didn't think I was going to enjoy marketing, but it's even beyond that, it's difficult to learn this in school, but it's really a little bit more about sales. It's marketing transitioning into sales. In other words, being able to put a positive spin on something that ultimately can be perceived negatively. A couple of years ago, the firm in the city was raising fees to clients, and they expected all of the advisors to explain to the clients why this is a good thing for them. And most people didn't want to do that naturally. Most advisors didn't want to call the clients they were assigned and tell them, hey, we're raising your fee for a lot of good reasons, and it's a good thing, and we're still pretty competitive. But once you get over it and you go ahead and you make that first call, you make the second, third call, you start to get into the groove, and you start to learn how to kind of spin the reality, which is, yes, you're raising their fee, but highlight the things that you want them to focus on. And it's not necessary. I mean, some people see that as problematic, but it's not being dishonest. It's being, it's looking after your own interest, because ultimately the firm felt strongly that they needed more revenue from the existing clients. Whether you agreed with it or not was, irrelevant. But if you accept that the firm needs more revenue, and the best way to raise that revenue is to raise the fees to the clients. Oh, and by the way, those fees were a little bit low to begin with. If you can accept that, then it becomes easy to adjust and to pass along that message in a way that's easier for the client to receive. So sales and marketing is all about empathy, stepping into the other person's shoes and understanding how they will perceive what you're telling them and what you're trying to get them to agree to. And sometimes you're selling your services. You're going to be on interviews. You're going to be selling yourselves. You're going to be, trying to convince the other person why you're the good person, you're the right person for the job. And it's easier said than done, is to step away from yourself for a second and really put yourself in the other person's shoes. They have to make a decision. They have a lot of other candidates. Think about the fact that they're pressed for time, and they probably have a specific budget. So they have to work within a lot of different parameters with a lot of restrictions, and ultimately they want you to make it easy for them to choose you.
Right. So what you are saying is, they say don't focus on yourself. What do you want to do? Instead, you want to make sure your message get across on the other side. Who should be the focus? Your clients,
yes,
your customers, right? To make your job really be effective, right? So that's, that's an important skill. A lot of people, when they present stuff, they were thinking, how do they get their idea clear, but instead how other people receive the idea and understand the idea, right? So it's been wonderful. Thank you so much for your time, Boyan. We really appreciate your sharing. Thank you very much.
Thanks, healthy, everyone, and thank you, Professor Jiang. Stay healthy and safe and sane, everyone.
Sure. Bye-bye.